Yu-Dee joins us, Principal and Chief Advisor at ACE Investment Strategist, live out of Washington, D.C. Yu-Dee, good to see you again. What do you say? AAPL blowing past expectations again. But let's talk about the guidance. Let's look forward and look into the future here. For Q3, looking for EPS at 8.68. The street looking for 9.93. So, you know, that's a fair way below. But then again, this company is very conservative with guidance. Does it worry you this time?
No, not at all. I think Apple tends to, like you said, being very conservative on its guidance, especially on its earnings. EPS-wise, usually it's about 10% below. On revenues, they're usually about 5% below. That's why this particular report, which just came out, really, like you were saying, blew past all expectations throughout the day, all day today, during the day, that is. Oh boy, they were so bearish in the U.S. We're talking about the fact that Apple had a technical breakdown below its 50-day moving average. We talked about the fact that both AT&T and Verizon were losing subscribers on Apple. We're talking about whether the sales in China could make up the U.S. weaknesses. But apparently this is all just wasted worries, I guess, where Apple just blew past everything, continuing to advance, and after hours up what, $37 already, and actually is pretty much right at its 50% retracement and is above its 50-day moving average now. Looking forward, I like Apple actually. I think the weakness is over. It's probably going to a continuous upward movement again.
Wow. Okay. Do you have a target on it?
Yeah, I think Apple, for the time being, you know, I actually expect a little bit of a consolidation, which means probably on the low end, about maybe 570, 580. On the high end, maybe about 620 or so. A little bit of consolidation and move upwards. I really think we'll see 750 on Apple.
Yu-Dee, what about the growth going forward? I mean, Apple's been growing so phenomenally. It's a lot like China's economy. You can't keep growing at that pace forever. What do you see going forward?
Yeah, but if you think about it, Apple's PE is around 16 or so. The PE on the S&P is actually around 14. And if you think about the iPad sales number, only pretty much contains only 2 months of the so-called iPad 3. And everybody is pretty much written off ITV, saying that, you know what, nobody is going to spend $2,000 buying a TV. So that is not even within the expectation yet. And also the fact that this is within the weak sales of iPhone 4, that is. iPhone 5 is going to come out, although a little bit later in the fall. So I think all in all speaking, I do still expect Apple to grow, continues to grow.
Yu-Dee, for the record, full disclosure, you are holding Apple stock, are you?
Actually, personally not. Family, yes. Right. Company, yes. And investment banking, no.
Okay, let me put this past you. The consensus opinion suggests, and Apple is sitting on a $100 billion cash pile, from what I hear.
110 by now.
110 billion.
Yeah.
Thank you, Martin. Analysts, investors, broadly looking for steady dividend increases from Apple, possibly on a biannual basis. Is that something that you would like to see?
Absolutely. I think that is a good question. I think the two things. One is, are you going to increase dividend? Two, what are you going to do with the $110 billion? We like to continue to see Apple spend that money actually to expand. I think on the flip side, sure, there are concerns, right? Like you were saying, reporting a little bit earlier, the patent infringement of Motorola. We're talking about the problem with the e-books. So there are definitely concerns. But with that said, especially with this current earnings, no doubt, Apple has proven once again that it really does have this tremendous growth potential.
Indeed. Yu-Dee, stay right there. A lot more to talk to you about in just a bit. Yu-Dee Chang, ACE Investment Strategist. Email us at squawk@cnbcasia.com if you have a question for him. Still.
Yeah, actually, Diane, you've been quoted saying that, you know, the French politicians is in a deep state or state of denial when it comes to their deficit problem. What about your opinion on the U.S. politicians? What stage are they in concerning our deficit problem?
Equally denial. I mean, you know, this is one thing, unfortunately, we share with France is a deep state of denial. And what's amazing is you're now seeing even, you know, sort of what are supposedly deficit hawks go out and sort of say we can have tax cuts without paying for them. You know, the reality is I'm all in favor of a plan where we actually let the economy be stimulated a little bit, and we don't want to roll off all of the Bush-era tax cuts, all of the, and have all the spending sequestration hit all at the same time, the sort of tsunami of fiscal policy that could really hit us at the beginning of 2013 to hit that way. But we do need a long-term plan of deficit reduction, and it's just ridiculous because you talk to economists agree, we've got a lot of agreement here, we know how to fix our problem, and Washington has turned a deaf ear.
Okay, we'll pick this up again in just a couple of minutes. We've got more to come with our guest, Wonk of Mesirow Financial, joining us from Chicago, and Yu-Dee Chang of ACE Investment Strategist joining us as well. If you have questions, send us an email. The address is squawk@cnbcasia.com.
All right, back with Diane Swonk, Chief Economist and Senior MD, Mesirow Financial, plus our guest host, Yu-Dee Chang from ACE Investment Strategist. Diane, clock's ticking. June twist ends. What is the Fed thinking? What are we going to hear at the end of this FOMC?
I think they're going to let the twist expire for now because, frankly, Europe's doing it for them. They don't need to do the twist to keep interest rates on the long end low. I mean, Rick just pointed it out, 195 in the long bond, and I don't think we're going to see a big pop up necessarily that many people were expecting in the 10-year at the end of the twist, as long as Europe is still sort of week on, week off crisis. And as long as Europe is out there, it's to our benefit right now. And, we are, as we said, as Rick pointed out as well, we look better relative to everybody else, even though the threshold and the bar here is pretty low.
And Diane, if the U.S. economy is starting to normalize, is keeping rates low until the end of 2014 the right approach?
It's debatable, but I think they'll probably do it before the end of 2014. That said, they're really trying to manage expectations. When you're in a liquidity trap, which was what we're in right now, all the evidence suggests that you want to signal to the markets that you're willing to give them a very long time at cheap money, make cash repulsive, and get them to make more risky, productive investments in the economy, and tell them you're not going to take it away from them anytime soon. You're not going to slow the economy down anytime soon. They really want to almost promise to reflate the economy, which is something the Fed has a little hard time walking that fine line, because that's what the theory on liquidity crisis, liquidity traps are. So that's what Ben Bernanke, the fine line he's walking now. And I think what you're going to hear tomorrow a lot on their decision rules, I mean, his last big speech, Yellen's big speech, they talked about labor markets. They hardly talked about inflation at all.
The statement, as always, will be scrutinised by the market. Is there a chance, in your opinion, that the Fed's reference to high gasoline prices and the transitory impact on inflation will be exonerated this time round, given the fact that we have seen global oil prices pull back somewhat?
Well, I think those... Right. Well, they're validated. They feel validated on it now, and so they certainly. I don't think it won't be in there because it still is a risk, and these prices go up and down pretty quickly. I do think we're in a better side of this now, but I think the Fed will still want to keep that out there. They're hedging their downside, and so they still want to keep it out there. And there are people that are inflation hawks that will still want to keep the line in there. Yeah, it's transitory, but keep talking about oil prices. Don't let it out yet. So I think it will still be in there. I think the real important issue is, this is the Fed really the best news for the Fed is to not make any news right now. And so I don't think you're going to see a lot of action. And talking about decision rules, I do think you're going to see a lot of talk about, that the need to keep monetary policy easy and not tighten it too preemptively. That's where the Fed is defending itself right now. And I think they feel a bit validated on that.
Yu-Dee?
Yeah, Diane. Also, there's a wide perception out there, especially for me, for us as a trader, saying that if economy worsens substantially, well, if we see a major pullback in the U.S. stock market, the Fed will be in there intervening with some type of quantitative easing, the so-called Fed put. Do you believe the Fed put is out there, thus the risk trade is still on?
I do, the put, I think, is the threshold, I think, for QE3 is higher than the market's giving it credit for. That said, I mean, what kind of pullback? The Fed is very concerned. They're going to have to react. They are in a position they will have no choice. If we do fall off this fiscal cliff at the end of the year or beginning of 2013, they'll have to compensate for that. regardless of whether they can do much or not. It's in their mandate. They will have to do something. So the question is what impact it will have. So although, the put is there, the question is if things will really deteriorate, and even if the Fed acted, how much do they have left to impact the economy? And they're even debating that themselves internally, but the bottom line is they'll have no choice, and they would do something if we fell off a fiscal cliff or if Europe really got, demonstrably worse all of a sudden.
Diane, a moment ago you mentioned the focus on the labor markets. Unemployment's at about 8.2% right now. That's where the Fed was predicting it would be at the end of the year. Is it possible we might get the Fed giving a brighter outlook on the jobs front?
Well, they'll bring down the unemployment rate because the unemployment rate has come down, but the overall economic forecast could be slightly stronger, but not a lot. Remember, a lot of, we got the economy goosed a bit in the beginning of the year because of unseasonably warm winter weather. I mean, they're playing golf here in Chicago in January. They just don't do that. I mean, it was unbelievably warm. In fact, it's gotten cold in April. It's very odd. I'm waiting for it to snow in July now. I just don't know what's going to happen. But the bottom line is that, that juiced the economy at the beginning of the year. We're getting some give back from that now. So the Fed sort of feels validated that they were conservative in their last statement. I think that's important. And the 8.2% unemployment rate, why did it fall to that level? Because people dropped out of the labor force. That's not the reason they want to see.
Diane, a couple of seconds ago you mentioned the Fed and reflation. I mean, one of the bits of thinking behind quantitative easing and just throwing money, low-cost money or even free money out there is hoping that it'll translate into wealth effect, help bank accounts, help mortgages, et cetera, as well, or at least to pay them down. Is this working? Because in terms of the spending that we are seeing, is it not true that a lot of it is coming out of savings and a lot of it is also being borrowed, that is on credit?
Well, actually, the savings part's actually true. The credit part is sort of a misnomer. The biggest run-up in consumer credit in the United States is yet another worry for the United States. It's almost all been in student loans on the non-revolving credit, not just auto loans. It's been student loans are now the second largest credit category. It's been phenomenal surge in student loans, and you really wonder about how many of those loans are going to be able to pay back because there's a lot of people who are going into college who aren't prepared for college, that are getting funding for college. So there's a very structural shift going on in student loans. On the credit card side, we've seen some comeback in credit. All of that almost has been in subprime, believe it or not, because that's the only place banks make money now. They actually can charge a pretty good risk premium for the subprime. And so, believe it or not, it's subprime credit. So that is supporting some spending. These are really important issues to sort of the subtlety of it, because the saving rate coming down is not sustainable. One of the other shifts that's gone on is spending on medical expenses has slowed down quite dramatically in the United States. And this is something that we've never sort of seen. And it's something that it's also had a big impact on medical services inflation. It's slowing down, and that's a big part of the overall inflation numbers. So again, these are things that the Fed's watching and saying, how much can we push the needle when there's some structural problems pushing back?
Right. Okay, Diane, thank you so much for your time today. We appreciate it. Diane Swank of Mesereau Financial, and we're going to have more to come with our guest host, Yu-Dee Chang of ACE Investment Strategist.
Wait a little bit before it give a little bit clarity where it sees, a less dovish stance. So I think from a data perspective, we're not going to get much out of Ben Bernanke this time. So our stance is fairly neutral. Overall, I would say still risks for some of the base metals to weaken in the short run due to less import from China. I think this is more important than we get out of the Fed. And on the agriculture side, I like soybeans in the short run, but probably we're going to hit a ceiling at $15 in the short run.
Yu-Dee, what do you think? What's the most compelling trade, in your opinion, on the commodity side?
Yeah, believe it or not, commodity is a big part of what we do. I think the most compelling trade for me right now is actually buying the volatility. If you look at it, the volatility is actually very low historically, whether it's in the currency market, in the precious metals market, and even in the energy market. Basically, everything is in a very tight trading range. So to me, that's actually the calm before the storm. So I actually like to buy both sides of it, maybe buying some kind of straddle or buying some kind of strangle on many of these markets.
Dominic, are investors losing faith in gold? It's getting awfully close to 1,600.
I think they will lose a little bit faith, and I think with the news flow that we get from Ben Bernanke, I think this is not going to be good enough to keep gold where it is. So we're still looking at the 1,520 and highly recommend you to buy some protection. I think, as just mentioned, volatility is low. I think you can do that at a quite cheap cost.
Just staying with the metals, Dom, a lot of people are telling me that there are a lot of opportunities in the PGM space. Would you agree? How solid are the fundamentals looking there? Because I've been hearing about disruptions and supply problems in South Africa, where most of this material comes from.
I think the story on the PGM is quite good, and platinum trades at marginal production cost levels, so clearly the downside is limited. It trades below gold, which also is for us an important factor. So in terms of return potential, I think here it all points to China. Are we going to see some acceleration in terms of car sales? Recent data has been rather disappointed. If you're positive, which we are for the second half, I think you definitely could see some higher numbers. Also on the palladium side, which is likely to be in a deficit of 2% of overall demand. So I think the story looks quite promising.
Dominic, whether it's precious metals or these base metals, which is a better way to get involved? Is it directly buying the metals themselves, or is it actually better to go through some type of mining companies?
I mean, on the precious metal side, very clearly I would favor direct exposure. I don't think there's much value in some of the gold mining stocks. You get double the volatility, and historically hasn't really seen good returns. I think the story is fairly balanced when we talk about the base metals. If you look historical performance, it can actually go in either or. I think there is a mixed view on what is your preference.
Dom, very finally on oil, is there reason to believe that we could test $100 a barrel soon because of the supply pressures that continue to mount in the world?
Definitely. I think if you look at the latest production numbers in the U.S., nicely above 6 million barrels, I think supply side can grow quite a fair bit. And I think inventory continue to go up. We see some improvement on the demand side in the U.S., but I think that's not going to change the overall situation. The U.S. is going to be, in that sense, to the world, a net supplier in terms of delta change that we see in 2011, 2012. I think there is no reason to see higher prices if you look at the US. So yeah, short-term price weakness in WTI, and even in Brent we're looking at a dip below $110 per barrel, simply as inventories start to recover.
All right, Dominic, good to know. Thank you very much for those insights. Dominic Schneider of UBS Wealth Management there, and our guest host, Yu-Dee Chang of ACE Investment Strategists. Lisa, back to you.
Okay.